This trade was perfectly legal. It made people rich, it looked safe, and it broke the world. Because the most dangerous financial disasters don't start with fraud. They don't start with lies. They start with logic, with an idea that makes sense, an idea that works until too many people believe in it at the same time. This is the story of how a single financial mechanism turned prosperity into ruin, how it erased fortunes, destroyed families, rewrote the social contract, and how that same mechanism is still with us today. In the early 1920s, America was changing fast. The Great War was over. Industry was roaring back to life. Factories that once made weapons now produced automobiles, radios, refrigerators. Cities were growing. Skyscrapers pierced the skyline. Electric lights replaced gas lamps. The future felt inevitable, unstoppable. And for the first time in American history, ordinary people were invited into the world of investing. The stock market was no longer something reserved for bankers and industrialists. It was for clerks, teachers, shop owners, housewives. Wall Street had democratized wealth, or so it claimed. Brokers had a message for the rising middle class. Why wait years to build wealth when you could accelerate it? They offered a simple, elegant solution: margin trading. Instead of paying the full price of a stock, you only needed 10% upfront, sometimes even less. The rest, borrowed from the broker at reasonable rates. With $1,000 of your own money, you could control $10,000 worth of stock. And at first, it worked beautifully. Stock prices rose year after year. Dividends came in like clockwork. Paper profits exploded across kitchen tables and barbershops. Newspapers celebrated the new era. Economists declared that the business cycle, the old rhythm of boom and bust, had been conquered by modern finance and industrial efficiency. Even respected voices claimed that stock prices had reached a permanently high plateau. For millions of Americans, leverage didn't feel dangerous. It felt like intelligence, like finally understanding how the game was played, like being let in on a secret that the wealthy had known all along. Leverage is seductive because it rewards you quickly. When prices rise, your gains aren't linear, they're exponential. A 10% increase in the stock price could double your actual money. A 20% rise could triple it. Every week brought new stories. The neighbor who turned $500 into $5,000. The barber who retired early. The teacher who bought a second home. And the more it worked, the smarter it looked. Friends told friends. Co-workers copied co-workers. Entire social circles synchronized around the same strategy. Success became proof. Doubt became fear of missing out. But leverage has a hidden property that few understood at the time. It doesn't just multiply individual gains. It synchronizes behavior across the entire market. When everyone uses the same strategy, they all react the same way to the same signals. On the way up, that creates euphoria, a self-reinforcing loop. Rising prices justify more borrowing. More borrowing pushes prices higher. It feels like perpetual motion. But on the way down, it creates something far more dangerous. Because leverage doesn't just amplify returns, it amplifies instability. It transforms a market of individuals into a single, tightly coupled machine. And when that machine reverses direction, no one can stop it. Not the brokers, not the banks, not the government. Because the logic is already embedded in the contracts, in the math, in the system itself. Here's the part most people didn't understand. When you buy on margin, you don't control the timeline. You've entered into a contract, and that contract has terms. If the value of your stocks falls below a certain threshold, the broker has the right, the obligation even, to demand more money immediately. This is called a margin call. You have hours, sometimes less. If you can't pay, your stocks are sold at whatever price the market offers in that moment. No negotiation, no extensions, no mercy. One margin call forces selling. Selling pushes prices lower. Lower prices trigger more margin calls. More margin calls force more selling. This isn't panic. This is math executing its logic. It's automatic, mechanical, irreversible. Once enough people are leveraged, collapse becomes inevitable. No conspiracy required. No villain pulling the strings. Just arithmetic. In October 1929, that arithmetic began to run. Prices fell. Margin calls went out. Stocks flooded the market. Brokers tried to slow it down. They couldn't. Banks tried to intervene. They failed because the problem wasn't psychological. It was structural. The system had been designed to amplify upward movement, and now it was amplifying downward movement with the same ruthless efficiency. Fortunes built over years evaporated in days. Families lost everything, not because they were reckless, but because they believed in a mechanism that worked until everyone used it at once. This logic didn't die in 1929. It didn't disappear with new regulations or oversight. It adapted. It returned in 1980s with portfolio insurance, an automated selling strategy that crashed the market in a single day. It returned in 1998 with long-term capital management, a hedge fund so leveraged that its collapse nearly broke the global financial system. And it returned in 2008. The names had changed. Margin became derivatives. Loans became structured products. Stocks became mortgage-backed securities. But the core idea was identical. Borrow to amplify returns. Assume liquidity will always be there. Trust that prices won't fall all at once. Layer complexity on top until no one fully understands the risk. Different instruments, same mechanism. And here's what makes this so dangerous.
Each time it breaks, we don't abandon the logic. We refine it. We add safeguards, circuit breakers, stress tests. We tell ourselves this time is different. But the fundamental architecture remains. Leverage is still embedded in the system, not just in individual trades, but in institutions, in pension funds, in central bank policy. When leverage becomes systemic, failure stops being a possibility. It becomes a schedule. The only question is when.
This single idea erased generational wealth. Not because people were stupid, not because they were greedy, but because the system rewarded belief right up until it punished everyone at once. The mechanics of 1929 are still with us, repackaged, renamed, rebuilt, but never truly dismantled. Because leverage is too profitable to abandon, too useful, too embedded in how modern finance operates. And so the cycle continues. Stability breeds confidence. Confidence breeds leverage. Leverage breeds fragility. And fragility eventually breaks. If you want to see how this logic turned the Roaring Twenties into the Great Depression, how millions lost everything while a few saw it coming, the full story is in the Great Depression documentary on this channel. Because the trade that broke the world in 1929 is still being made today.